Hello students, welcome to my class. This is Professor Vincent Usaya, and this is the presentation of Chapter 7, Internal Control and Cash. As you know, we completed the process of completing financial statements in the previous chapters. Now, moving forward, we are going to zero in on only one element or one issue or one line item on one of the financial statements that we discussed. In this case, we are looking at the balance sheet and we are looking at the cash. All right, so this chapter deals with two issues: internal control and cash. So let's take a look at the objectives of this chapter. Number one, we are going to talk about the definition of internal control. Numbers two and three, we are going to talk about how to apply internal control to cash receipts and cash disbursement or cash payment. Then we are going to talk about how to journalize petty cash transactions. And number five, we are going to take a look at how to perform a bank reconciliation. And number six, we are going to use a ratio to evaluate business performance. So those are the six objectives of chapter 7. So now let's take a look at the first objective, the definition of internal control. We said that internal control, any plan with their related measures, procedures that you put in place in order for you to safeguard your assets and meet other objectives will be considered as internal control. So here are the four main objectives that a company is trying to meet. Number one, safeguard assets, encourage employees to follow company policies, promote operational efficiency, and ensure accurate, reliable accounting records. So the plan that the company put in place with the related measures, policies, procedures to make any of these four things happen is what we call, or what we mean by internal control. Now, let's take a look at the first bullet. It says safeguard assets. Think about some of the controls that you must have observed out there that companies put in place to safeguard their assets. One that would be very prevalent, or that everybody probably might be familiar with, is if you go to the retail department store that sells clothes, they have sensors on clothes, the security sensors on clothes. The company embarked on that kind of measure in order to safeguard their assets. Which assets? In this case, inventory. Inventory is one of the most valuable assets of a merchandise company. Now, let's take a look at another objective: encourage employees to follow company policies. So the procedure that you put in place to make sure that that happens is also part of your internal control. And the last one, ensure accurate, reliable accounting records. Now, we are going to talk about internal control in relationship to assets. We have different types of assets: accounts receivable, land, equipment, so on and so forth. But because cash is the most valuable and the most vulnerable asset of a company, we are going to look at internal control specifically as it relates to cash in this chapter. So moving along, components of internal control. We said that for you to have an effective, good internal control system in place, you need 5 things to be in place. These 5 things have to be put in place, and these 5 things have to be properly played out. And the 5 components are control procedures, risk assessment, information system, monitoring of controls, and environment. Now, these 5 components are not arranged here in the order of importance. As a matter of fact, the most important of these 5 elements is the last piece, which is environment, also called control environment. Control environment or environment actually deals with the tone that management and board of directors set on top of the organization in relationship to internal control. In other words, how serious are the board of directors and how serious are top management when it comes to internal control issues. Very likely, if they take internal control very seriously, everybody in the organization does not have a choice but also take internal control very seriously. One quick example is if you use profanity. Unrelated example is if you use profanity language in the presence of some children, they will quickly tell you, oops, don't say that word. If you go to the household of those children, you realize that their parents don't tolerate profanity language. Whereas you hear some children use profanity language all day long. If you go to their homes, you also find out their parents use profanity language. Doesn't mean anything. So I'm saying that to say that control environment is extremely important. Everybody in the organization takes it seriously, internal control seriously, if top management and board of directors also do so. So you can read a little bit more about the other elements yourself. As far as this chapter is concerned, internal control is important, but it's not extremely important in relationship to how we discuss it in other accounting classes. Now, moving along, let's take a look at the internal control procedures. Okay? Here are some of the procedures that we put in place to make sure that our assets are safeguarded. Well, I'm talking about all assets. Again, like I said, in the case of this chapter, we are zeroing in specifically on cash. So let's take a look at some of the procedures. Number one, competent, reliable, and ethical personnel. So it is important for you to hire people that are competent, they are reliable, and of course, if they are competent and reliable and they are not ethical, that is an issue. So you also need to make sure that they are ethical as well. Number two, assignment of responsibilities, separation of duties. Let me give you an example. I belong to a very small church with about 70 to 80 members. So I am one of the individuals that is responsible for the finances of my church. One of the first things that I did 9 years ago when the church was established was to set up the internal assignment of responsibility so that duties can be properly segregated. For example, the individual or individuals that authorize transactions as to whether they need to be paid or not are different from the individuals that actually will write the check. And the individual that is responsible for record keeping is also different from the individual that writes the check and the individual that authorizes the transaction. So we talk about authorization, custodian, who actually keep the check, who actually keep the money. And number three, the record keeping. Of course, the record keeping is my responsibility. I don't have any authority to sign a check, but I love to be in a position whereby I can see everything that is going on. So we have all those segregations separated. I mean, of course, we have the person that is responsible for counting the money, the people that are responsible for counting the money, and the person that is responsible for depositing the money, so on and so forth. Again, like I said, all these duties are properly separated. For our pastor, he doesn't have any function whatsoever when it deals with money. He doesn't count money, he doesn't deposit money, he doesn't know where the checkbook is, absolutely nothing. Again, so take a look at other issues: audit, fireproof vault, alarm, job rotation. So those are some of the procedures that we put in place to make a good internal control. Moving along, let's take a look at objective 2. How do we now apply internal control specifically to cash? So let's take a look at cash receipts. So what are we talking about here? Here we are talking about the measures that you put in place to protect your cash when you receive your cash. All right. A lot of big, medium-sized companies are able to do a lot of things to prevent people from stealing cash when they are received. But for small companies, it is a challenge. Let me give you a true life example. I had a client about 12 years ago who has a full-time job. At the same time, he started a business by the side, a cleaner's business. So he hired people to work there while he's at work Monday through Friday, 9 to 5. So what happened is, as time progresses, the numbers were not adding up. Every week on average, they will collect about $700, $800, $900 at best every week. So in terms of paying the overhead and everything that needs to be done, it was a challenge. So after 4, 6, 7 months or so, I encouraged him to take a vacation from his regular job and stay at the cleaners Monday through Saturday without going anywhere except if he has to use it. And I told him that if he has to use it, he needs to quickly use it and come back. That same week, believe it or not, they collected about $1,400 versus average of $800, $900 that they normally collect over several months. Obviously, somebody was stealing. Eventually, those people confessed, and and you have to let them go. Now, so that is a very small establishment, a small entity, and again, like I said, there's just a limit to what you can do to safeguard your assets. But I'm going to give you some examples, real life examples of what I personally recommend to my clients in order to protect their cash, either during the process of receiving it or during the process of disbursing or paying it. So moving along, let's take a look at internal controls for cash receipt. So look at this diagram. Typically, a mailroom employee opens all mails and records the checks on a remittance advice. A remittance advice is simply a document. So a customer usually will send this remittance advice along with a check. So if you're in a position whereby you ever receive a check from a vendor, they will also send the remittance advice as well. So the mailroom opens all mails, the mailroom employee opens all mails and records the checks on a remittance advice. Now, number 2. The treasurer is responsible for depositing the checks, documented with a deposit slip. So as you can see, the treasurer primarily is responsible for depositing the check. He has the custodian responsibility. Now, the remittance advice that is on paper goes to the accounting department where it is recorded. So the controller or the accounting department is responsible for doing the paperwork, while the treasurer is responsible for the custodial function that is actually holding the money. So the custodial function and record keeping are two separate functions that are separated. So the controller office matches the remittance advice and the deposit receipt in the accounting department. So essentially, that is how a typical company will map out different separation of duties in order to protect or safeguard their cash during the process of receipt. Now, let's take a look at objective number 3, how we apply internal controls to cash payment. Now, here, so let's go ahead and start objective 3 with part 2 of this presentation. So this will be at the end of part 1 of the presentation.